In this video, we'll discuss the statement of cash flows and more specifically the operating activity section, which we know includes cash inflows and outflows resulting from the normal business operations of a company. Now, GAAP will allow this section to be prepared one of two ways. That as we've seen in previous chapters, this is going to explicitly identify the major sources and uses of cash. And the indirect method is going to start with net income, followed by adjustments necessary to convert the accrual-based net income to a cash basis equivalent. Now, while these methods differ in process, they will arrive at the same amount of net cash provided or used by operating activities. So, when we're preparing the indirect method, there are a couple of steps to follow. The first step is to go to the income statement and find the net income or net loss and enter this as the starting point under the statement of cash flows operating activity section. Most differences between revenues and expenses recognized on the income statement and the cash flows are related to changes in the balances of the non-cash current assets and current liabilities. We'll get into these more in just a second. But step 2, we'll go to the income statement and find depreciation expense, as well as any losses on sales or disposals. Because these amounts are non-cash items, they will need to be added back to net income to arrive at the cash basis operating activities or cash flows of operating activities. Then we'll need to go to the income statement and find and remove any gains on sales or gains on disposals, because again, these are cash items and they will need to be removed from the net income amount to arrive at the operating cash flows. Lastly, we'll need to review comparative balance sheets, which is just 2 consecutive periods of balance sheets. We'll need to assess changes in the current assets and current liability balances. If current assets is an increase, then we will decrease the cash flows by that amount or subtract that amount from net income. Conversely, if a change in current assets is a decrease, then we will add that amount back. We'll think of current assets and cash flows having an inverse relationship. And now we'll look at the current liabilities, and if the change is an increase, then we should increase operating cash flow or add that amount. And if a change in current liabilities is a decrease, then we will decrease that amount. So current liabilities and cash flows have a direct relationship. A reminder here is that we should only be looking at changes in current assets and current liabilities. So the effect or the change between long-term liabilities or long-term assets and long-term liabilities are not of our concern for this particular process. So let's do a quick example. We have New South Company beginning operations in year 1 with the following events and income statement. The company earned $500 of revenue on account and collected $400 cash from its customers, $90 of expenses, and paid $350 in cash to settle its accounts payable. When looking at their income statement, there are revenues of $500 and expenses of $390. Therefore, the net income for New South for year 1 is $110 because it's revenues minus expenses. The problem wants us to prepare the operating activities section of the statement of cash flows using both the direct method and the indirect method. So let's start with the direct method, which is the most simple, or I say most simple, which is the method that we are used to preparing. So I already have here the cash flow from operating activities section starter line. We'll then need to look at the problem and see whether there was cash received or cash paid out. So in the first bullet, the company earned revenue and collected $400 of cash from its customers. So cash received from customers of 400 inflow. And in the second bullet, the company incurred $390 of expenses on account, but it paid $350 cash to settle its accounts payable. So cash payments for expenses is negative 390 or 350. So the net cash flow from operating activities, because there's no other cash being received or paid out in this problem, is $50. Now let's look at the indirect method. We just learned that we need to start with net income from the income statement. So if we go to the income statement, we see that the net income is $110. So I will put our starting point of $110 here of net income. Next, we need to adjust net income for any depreciation expense, any losses, any gains, and then any changes in current assets or current liabilities. So just thinking through the list, I do not see any mention of depreciation expense specifically. I do not see any losses or gains on disposal of assets. However, I do see the company earned revenue on account, which is an accounts receivable or a current asset. The company also incurred $390 of expenses, which is an account payable or a current liability. So these two accounts, we should assess the change from the beginning of the year to the end of the year, which would be from one balance sheet period to the next. So if the company began their operations in year one, so starting at zero, ground zero. So we're looking at accounts receivable first, ground zero, or the beginning balance before operations in year one is $0. We need to add any sales accounts, accounts receivable accounts. So we have $500 of sales on account. And we need to remove any collections. So $400 gives us $100 ending balance. So if we started the year with $0 and we ended the year with $100, the change is $100. So the first thing we'll list here is the increase or change, the change in accounts receivable, which is the increase of $100. And accounts receivable is a current asset, and we know that current assets have an inverse relationship with cash flows. So an increase in the current asset will be subtract So we are subtracting an increase in accounts receivable of $100. Next, we need to look at the current liability account of accounts payable. Again, we're starting the year with no operations. Last year we're zero. We just started operations, so $0. We need to add any expenses on account, so $390. And then remove any payments to settle those accounts, so $350, which gives us a $40 ending balance in accounts payable. That is an increase from $0 to $40. And we know that accounts payable is a current liability. And current liabilities have a direct relationship with cash flow. So an increase add to net income to get to cash flows from operating activities. So add an increase of accounts payable of $40 gets us to a net cash flow from operating activities. Now, again, it's important to note that no matter the method used, we see that net cash flow from operating activities is $50. So it's the same end result. Now, why might companies use the indirect method if it seems a little bit harder? Well, we know that companies are required to prepare their financial statements under the accrual basis of accounting, and therefore starting at net income might be easier than tracking every single cash transaction from customers or paid for any expenses or things like that.